Hello and welcome to Market Domination. I'm Josh Lipton, live from our NYC headquarters. Investors are on Fed watch today. Multiple officials from the central bank are speaking and investors are listening. They're also digesting fresh economic data that looks promising. We're digging into all those stories. But right now, there's just an hour to go till the closing bell, and stocks, they are lower. Let's take a look at the popular averages here. The Dow is down about 170 points. The S&P 500, your broad gauge, is down about 0.5%. Tech-heavy NASDAQ also down about 0.5%. Let's welcome in now Fed correspondent Jennifer Schonberger. We've also got our data and markets editor Jared Blickery to break down the headlines. Jared, let's start with you. What are you seeing in the market so far, Jared?
Third down day in a row for some of these indices, and the majors we're talking about, the Dow, NASDAQ, and S&P 500, each down from about 1/3 to 0.5%. Not a huge amount, but let's track the intraday price action. You can see the Dow has been in the red all day, almost climbed into the green in the first hour, hour and a half, but well off of the lows now, having sunk right around the 2 p.m. hour. And NASDAQ, pretty similar chart there, although that 2 p.m. fall didn't quite take out the lows from earlier in the day. And here's the S&P 500, another very similar chart there. Let's take a look at what's happened this week, because we have had a number of down days. We started off on a nice note, but S&P 500 not even losing 1%. NASDAQ a little bit worse off, down 1.1%. But I want to show you the Russell 2000, which is down almost 1.5%, having its worst week since the beginning of August. So the Russell 2000, if you're keeping track, just punched to a new high, the first one in 4 years. That was a record, and now just kind of has slumped back into its old trading range, and that is par for the course for the small cap index. Here's a 10-year T-note yield. That is up 3 basis points. Again, this is a week-long look. You can see there was a bit of a lift-off yesterday that has continued today. The 30-year is, we're going to call that down to 4.75%, well below that 5% mark that sometimes spook stocks. And let's take a look at the US dollar as well. That has been trending higher over the last 2 days, up 1.25%. That's not nothing for a currency, especially the reserve currency of the world. We're going to come, well, let's stick with the NASDAQ 100 here. Apple up 1.5%, Tesla down almost 4%, and a lot more red than green it's looking like. And let's confirm this with a look at the equal weight. You can see Intel there. I was just checking out Intel. That is up 9% today, ever since that deal there. Let's see if we can pull this up. There we go. There's Intel. Let's get a 2-year chart, because it is right back to the levels that we saw about 1 year ago. And over this time frame, just about break even. So Intel really punching back recently. And let's move over to the sector action for the day. Only energy in the top spot there. Crude tacking on to gains over the last few days, up about 1/3%. Nothing huge, but that is the only sector in the green right now. The worst off is XLV, that is healthcare. Then you have consumer discretionary and materials. Those are all down more than 1%. And let's take a look at the Dow here. Aside from the mega caps, just took a look at those. IBM, another standout. Big Blue up 4%. Walmart, J&J also in the green, and energy. We got Chevron kind of leading there. So it's been a lackluster day for a lot of these sectors. And I'm going to finish with my leaders and sentiment board here. Solar, that's a TAN ETF, that is in the green, so is small oil. So if you're tracking that, that's the energy market. China's just barely positive, but it looks like Bitcoin not having the best day. We'll look at crypto in a second. And effect, let's take a look. Bitcoin down 3.3%, Ether down 5%, and some of these other coins, looks like Solana's down 6%. So kind of risk off for a lot of different sectors we're looking at here, Josh.
All right, Jared. And looking at the Federal Reserve as well here, because Fed officials, they continue to share their remarks this week, sending mixed signals on interest rates. Jen, what is the latest from the Fed?
Hey there, Josh. Yeah, that great debate within the Federal Reserve over just how much to cut interest rates further continues to rage on. We heard today from Kansas City Fed President Jeff Schmidt, along with Chicago Fed President Austin Goolsbee, who both struck a note of caution over the notion of a series of rate cuts over concerns of sticky inflation. Kansas City Fed's President Jeff Schmidt, a voting member of the FOMC this year, who has been in favor of holding rates steady for much of the year, said he favored cutting rates last week because he viewed it as appropriate risk management, though he seemed to indicate that further rate cuts was not something he particularly might favor. While he was more concerned about sticky inflation heading towards 3% rather than back down towards the Fed's 2% target, it was the weaker recent jobs data that convinced him that perhaps the job market is weakening more substantially or abruptly than thought. Schmidt saying in a speech earlier today in Dallas, Texas, that, quote, "My view is that inflation remains too high, while the labor market, though cooling, still remains largely in balance. I view the current stance of policy as only slightly restrictive, which I think is the right place to be." Now, Schmidt said he's going to take a data-dependent approach to setting monetary policy in the future. Meanwhile, Chicago Fed President Austin Goolsbee said that he is somewhat uneasy with front-loading a series of too many rate cuts based solely on weaker payrolls. Goolsbee saying, quote, "If we are in this environment where inflation's been above the 2% target for almost 5 years in a row now, and it's going the wrong way, just counting on the inflation to be transitory makes me uneasy." Now, elsewhere, we also heard from Fed Governor Michael Barr for the first time since the Fed cut rates last week, and he too expressed that he favored a rate cut last week as a move of risk management, though he cautioned about the inflation side of the Fed's dual mandate, saying that that would actually call for the Fed to hold rates steady or even hike rates, while the employment side of the Fed's dual mandate would call for lowering rates. And so he said, as the Fed looks for future adjustments, it's important to keep a watchful eye on inflation. He still thinks going forward, the move is lower over time. On the flip side, we also heard again from Fed Governor Michelle Bowman, who again expressed concern about the job market and seems to think that the Fed should focus on that over the inflation side of their dual mandate. We got some color on just how many rate cuts that would spell this year. Take a listen.
So in my mind, I think that means that we may come to see 3 rate cuts by the end of this year, as I had initially projected in December of 2024. When we see that one of our mandates is the conditions are more fragile than potentially the other side of our dual mandate, then we should be refocusing our monetary policy decision-making to focus on, bringing our policy rate closer to neutral so that we're not unnecessarily restricting economic conditions based on where the policy rate is. So in my mind, I think we have some space to bring down the policy rate closer to neutral so that we can support the labor market.
Now, that's still not as much as Fed Governor Stephen Miron, who again reiterated to Bloomberg Television earlier today that rates in the range of 4 to 4.25 are still highly restrictive and make the economy vulnerable to downside shocks. And remember, Josh, Miron has penciled in 5 more rate cuts for this year, by far the most dovish on the committee.
All right, Jen. Thank you. Appreciate it. Well, the Fed cut rates, shifted its dots dovish, and now faces a possible shutdown in key PCE data. That's on the way. Nomura chief economist David Seif joins us now to dig into all of it. David, it is good to see you. So I want to start David, on that economic data we got this morning, because we got a rush of it. It was broadly, David, you look at it and say, all right, it was stronger than expected. We got Q2 GDP. I realize, all right, old news, but still revised up to 3.8%. Real consumer spending, that goes to 2.5%. Jobless claims, and of course, Dave, we've been obsessing over the labor market here, that fell to 218,000. That was below consensus. What do you make of all this? I mean, do you think maybe, is it possible a lot of the hand-wringing, David, we've seen about a downturn, could that turn out to be exaggerated in your opinion?
Well, it seems as though the downturn is really only playing out in some of the labor market data. And by and large, the balance of data that we've gotten, not just today, but I'd say for the last 2 weeks, have been much, much more positive than negative. So the data we got today, we also had very strong durable goods numbers. And then going back to last week, strong retail sales numbers that showed that consumers are still spending. And as you pointed out today, jobless claims falling to a point where it looks as though the number of layoffs that are just coming down the pike is extremely low. So even if people are not necessarily finding new jobs, people who have jobs are keeping the jobs that they do have.
Now, our colleague Jen Schonberger was kind of wrapping up all the Fed speak today. What did you make of the Fed's recent decision to cut by 25? I had an economist on the show yesterday, David, who disagreed with that decision, and he disagreed because he agreed with Stephen Myron and thought they should have done a jumbo-sized cut.
Well, the 25 basis point cut was very much as expected. It seemed appropriate given some of the, I would say, yellow flags, but not red flags. What I thought was actually most interesting about the decision, though, was the dot plot and the economic projections that came out. And what was so weird about it was that every single change in the economic projections versus the last one in June was hawkish or positive for the economy. So you had the Fed say that they think growth is going to be higher, they think unemployment is going to be lower, and then also they said they think inflation is going to be higher. So all three of those things, all three of those changes should lead us to think, oh, well, the Fed is going to, if they're going to shift, they're going to shift hawkishly. And in fact, the dots became more dovish. And so this is really, there's really no easy way to reconcile this. 11 of the 12 members were the same as last time, only Myron was new. So it wasn't a matter of a change in the composition. It really looks increasingly as though the Fed is somewhat changing its reaction function, being more tolerant of above target inflation. And that does create a risk going forward. I think since then, what we've seen in some of the speeches is we're seeing that even though the only dissent was new Governor Myron, there's a lot of disagreement among the other 11 members on the FOMC, as well as from the non-voting members. And so you're seeing that increasingly in the speeches today, in some of the speeches we got earlier this week, where you have Myron, Bowman, likely when Waller does speak next, he'll join them, advocating for a more dovish path of interest rates. And then you have several other speakers, Goolsbee today, Musalem, speaking about the need to keep things a little bit, be a little bit more cautious with rate cuts. And I don't think that tension is going to go away anytime soon.
So we're going to see this debate. We're going to see this healthy disagreement.
Yeah.
What do you actually think the pace of cuts looks like, though? What would you be penciling in this year and next right now?
Well, we're thinking that at Nomura that the Fed will go ahead and deliver its dot plot of 25 basis point cut in both October and December, so the final two meetings this year. We also think that the Powell Fed will deliver one more cut in March. Further down the road, post-Powell, so starting at the June meeting next year, we will have a new Fed chair. And although we don't know who that's going to be, given that it will be President Trump's choice, it seems likely that that new Fed chair is going to be significantly more dovish than Powell. Now, the Fed is a vote. The FOMC conducts a vote, but usually there's a lot of deference given to the Fed chair. So we do think that there'll probably be a couple more cuts, 2 more cuts later in the year under the new Fed chair, mostly for political or for change in composition reasons, as opposed to because the economic data really justify it.
Can I ask you what you think this series of cuts, if we get that, what would that mean for the housing market specifically? We know the Fed pays a lot of attention to it. We've got more data this week, new home sales, got existing home sales today. Yes. You know, the housing market is challenged. What do you see ahead there?
Yeah, I mean, it's certainly a challenging market for housing. We had a great new home sales number yesterday, but that was sort of an outlier. Overall, transactional volume in housing has been really in the doldrums for years now, one could say. It seems as though the most important single factor here is what happens to mortgage rates, and it's that 10-year rate that is most important. So the key thing, or the key question is, if the Fed cuts rates, which is the short-term rate, the Fed funds rate, is that going to lead the 10-year rate to also, the yield on the 10-year rate to also decline? That's a real question. Normal times, the answer is yes, that the two of them tend to go hand in hand. But the question is here, if people think, the Fed is making a mistake here, the Fed is cutting rates in a way that's going to let inflation rise, it's going to lose credibility on inflation, investors might demand more money to lock up, more of a yield, to lock up their money for 10 or longer years. And that actually might mean that the 10-year rate might not go down, the yield might not go down in line with Fed cuts, or it could even go in the opposite direction. So that's, I think, going to be the most important determinant for is there a recovery in transactional volume in housing, or does it remain at this very low level we've seen for the past couple of years?
Final question I want to squeeze in, possible government shutdown in our nation's capital. How do you think through that as an economist?
Well, we think that most likely the impact on GDP will be pretty limited. There will probably be a hit to GDP this quarter if it happens, but typically government workers get back pay once the government reopens. I think what's arguably more interesting here is, could we be in a situation where the Fed is flying blind because there isn't any new data coming out? If the government shuts down, we think data publications will cease. So we might not get that October 3rd employment report. We might not get that October 15th CPI report. And we could actually find ourselves on October 29th, at the next Fed meeting, in a situation where the Fed has received no new top-tier data from its previous meeting. And in that case, how could the Fed not go ahead and cut? If it said it was going to, if it indicated it was probably going to cut in October, and it doesn't have any new top-tier data, we think it would be pretty likely to simply go ahead without a reason to deviate from that.
David, always great to see you, especially on set. Thank you, sir.
My pleasure. Great to be here.
Coming up, we are in the throes of a crypto sell-off. What's behind it and how long will it last? Plus, a Solana-focused cryptocurrency treasury company having a big coming out party after an infusion of $300 million. We're speaking with Soulmate's CEO. And construction of new homes may be contingent on the current economic climate. We're talking to an expert to catch you up on everything you need to know. Those stories and more coming up. Bitcoin slipping below 110,000 in Thursday's trade amid a broader sell-off in crypto and stocks. Yahoo Finance's Inez Ferre joins us now with more. Inez.
Josh, heavy liquidations have been weighing on the crypto market. More than 1.6 billion in long positions were wiped out earlier this week. That's followed by another 500 million over the past 24 hours. That's forced selling consisting of leveraged trades. So liquidations have been really amplifying the pullback that we've seen, the rollover that we've seen with cryptocurrencies. Right now, we're looking at Bitcoin down more than 3%, ETH down more than 5%, Ripple down more than 5%. But I just want to pull up that 5-day chart, those liquidations I was talking about, and take a look. ETH down 11% over the last 5 days. Binance down more than 8%. So you are seeing Solana down 15% over the last 5 sessions. So altcoins taking it on the chin, even more so than Bitcoin. But remember that September tends to be a seasonally weak month for crypto. There is also another headwind that crypto bulls have been pointing to, and it has to do with liquidity. This is money that's sloshing around. So the Treasury General account, not to get too wonky here, basically the checking account of the government has been getting filled up over the last several weeks. So through the issuance of T-bills and bonds, that soaks up liquidity, and that fill up diverts cash from other assets like crypto. So that's putting pressure on these crypto assets. But that headwind, though, should be subsiding as the TGA is just about filled up. The next 3 months, the strategists say, tend to be bullish for Bitcoin.
Thank you, Inez.
Thank you.
Digital asset treasuries are gaining traction on Wall Street. These treasuries are public companies that, instead of mainly holding cash on their balance sheets, buy and hold digital assets like Bitcoin, giving investors indirect exposure. So far, more than 180 public companies have added Bitcoin to their balance sheets, many just in the past year, according to BitcoinTreasuries.net. Now a new player is entering the space, but this time the bet isn't on Bitcoin, it's on Solana. Sports business firm Brera Holdings is rebranding as Soulmate, shifting to a Solana-based digital asset treasury and crypto infrastructure platform. Shares of Rubrik have been under pressure in the past month as investors become weary of the stock's valuation and the demand landscape. Still, that stock is up over 100% since its IPO last year. Market Catalyst host Julie Hyman and executive editor Brian Sozzi sat down with the CEO earlier today.
We had an excellent quarter. We grew our ARR by 36% at 1.25 billion total ARR. Our top line grew more than 50%, and we generated 57 million in free cash flow, which is 19% cash flow margin. So if you look at the top line growth of more than 50% and free cash flow margin of 19%, we are in this rare air. Look, I will leave the stock market reaction to the experts. but we are growing strongly in a very large market. I mean, cyber resiliency is the top priority for cybersecurity.
As someone that has spent a long time in the tech industry, are you surprised we're hearing about people concerned about peaking AI investment? Like, it just seems, I mean, I just came back from California for that Goldman Sachs tech conference. Everywhere I go, there's AI signs on the road, all over the place.
I mean, we are living in a world where $100 billion is like nothing. It's like everyday news. But that is the scale of the AI opportunity. If you just look at, for the first time, technology will actually replace human labor, or has the potential to replace human labor. And that actually changes the game. It changes the game for operations, it changes the game for cyber. Now somebody could take over your whole business processes and can do 10x damage in 1/10 of the second. So it's 100x more risk with AI, but 100x more opportunities, and that's where all the excitement comes from. But again, there is always overinvestment.
Yeah, well, and I don't know if it's that investment is speaking or if it's the money is real, right? That maybe is more the concern. But when it comes to cybersecurity in particular, because it is sort of an imperative, right? You have to protect your stuff. Do you feel like that it is more secure in terms of a business than some other parts of the AI landscape or the enterprise tech spending landscape?
Look, cybersecurity has changed in the last 15, 20 years. It used to be a bored teenager sitting in their parents' basement and trying to show middle finger to large organizations. Nowadays, it is like a threat actor sitting in Korea, sitting in North Korea and other countries, and they are trying to inflict damage like industrial espionage, cyber warfare, monetization of attacks such as ransomware. So it's a different ballgame. And as we are doing more digital transformation, AI transformation now with ChatGPT and everything else that has come up, the surface area is increasing. And so vulnerability continues to drive the demand for cyber, and I see robust demand for cyber for the foreseeable future.
How good are AI agents then? Yes, they may get things done, but what type of risks are they bringing inside of corporate America?
Funny you ask. We just announced Agent Rewind. People are concerned that agents are actually doing business work, business processes, such as doing a refund for some product that you have bought, or actually approving an expense on behalf of the CFO. And if these business processes hallucinate because the agents are probabilistic system or some external threat actor controls these agents, then it can inflict tremendous damage and do tremendous damage to the organization. So everybody is asking for what is the remediation strategy. And that's why we launched Agent Rewind, to really undo the work of misbehaving agents.
So if AI and the expansion of the use of AI also increases the sort of surface threat area, if you will, is AI the best way to protect against that?
Absolutely, because volume variability and velocity of attack is only increasing. So we have to fight machine attack by machine. So us as defenders have to even accelerate our journey into AI so that we can use more advanced technology, more advanced AI to combat this incoming danger.
Since we talked, I believe at the time of your IPO, it feels like yesterday, but I've sensed not a shift, but you're really trying to expand your product offering. You recently made a pretty big acquisition. What does that do to your business, and how does it change the financial complexion of it?
Rubrik is the security and AI company. Obviously, cyber resilience and cybersecurity is where our core focus has been. But we see tremendous opportunity in AI operations and helping our customers confidently adopt agents. So we acquired a company called Predibase that actually creates accurate results from models by fine-tuning the model, as well as reduce the cost of inferencing. Plus, Agent Rewind undoes the action of misbehaving agents. So we are looking at this whole agentic operation holistically and saying, how do we give our customers the tools, the technology, the confidence so that they can do AI transformation and agentic transformation fast?
And how are you finding, especially as a public company, that you are differentiating Rubrik from other cybersecurity giants that are out there that are competing with you?
We have a completely different strategy. The cybersecurity giants are in the prevention and detection business, which has been a huge business. But our thesis is assume breach, assume that attacks will happen. And how do you continue to operate your business? And this is where we are building newer technology. This is where Rubrik Security Cloud and preemptive recovery engine has been the boon for our customers.
You have a phenomenal personal story, Bipul. You came over here to work in Atlanta, from India,
yes.
right? So I think you offer a unique perspective on what we're hearing about H-1B visas. Zoom out first. What does this issue mean to you, and what's the wider impact to the tech industry?
Look, I came to America on H-1 visa, and I believe that America needs the best talent in the world. And so I leave the policy changes to the experts, but I believe that pathways for top talent from around the world has to come to America.
And are you all using H-1B visas also to bring talent to Rubrik?
It's not a significant part of our strategy because we have operations in 19 countries and we actually hire local talent. Having said that, definitely we want pathways for top talent from around the world.
Do you think you will be more likely to hire folks locally given that $100,000 fee? Will you keep the employees in those other countries rather than bringing them here to the US?
We always hire folks locally. Mm-hmm. I mean, we are a huge recruiter from all top universities in America. And we want to build the top company. I want to build a generational company. The opportunity that I got as an immigrant, I want to create this opportunity for everyone in America to reach to their highest career potential, and that's what we are focused on.
Thanks so much for coming in.
Good to see you.
Thank you.
Coming up, who are the leaders and the laggards today? We're taking a deep dive into Wall Street's trending tickers. Stick with us. You won't want to miss it. Mortgage rates are easing, and the Fed's September rate cut is giving fresh momentum to housing. Meanwhile, new home sales surging more than 20% to their fastest pace since 2022. We're navigating what all of this means for home builders with the Yahoo Finance playbook. And joining me now is Rafe Jadrosic, Senior Equity Analyst of U.S. Home Builders and Building Products at B of A Securities. Rafe, it's great to see you. Maybe to start, Rafe, I'm just curious to get your take on kind of just the broader U.S. housing market, where we're at, Rafe, because we have gotten this rush of data this week. We got existing home sales today, that's basically flat. We got new home sales, which surged, though I know some folks are kind of scratching their heads a bit at that number, but I'm interested to get your take.
Sure, and thanks for having me. So like you mentioned, we would caution reading too much into that new home sales data. There tends to be some pretty significant revisions to that data. But we do think there has been a bit of a stabilization in the housing market at a pretty depressed level. Housing demand definitely slowed through spring, but as mortgage rates have come down from about 6.9% where it peaked earlier this year to 6.3% where it is today, there has been a stabilization that home builders are now talking about, which we think sort of continued into August and September.
Let me ask you, Rafe, so the Fed did cut, and we're sort of all now debating what the pace of cuts looks like from here. If you did see a series of cuts, Rafe, what would that mean for the home builders you cover?
So one thing that's important is when thinking about Fed cuts and how it impacts housing is what really matters what happens to the mortgage rates, not necessarily to the Fed funds rate. And you actually saw on FOMC day, the 10-year Treasury yield went up, not down, and mortgage rates have ticked up a small amount since then. So what matters more would be what happens to the long end of the curve and then the mortgage rate and mortgage spreads. Now, if the 10-year Treasury yield were to come down, that would definitely have an impact to mortgage rates, which would be a tailwind to the market. The biggest headwind that buyers have today is really affordability. Builders have been sort of fighting against that with using rate buy downs and different incentives. So it sort of depends what happens with the mortgage rate to drive that. But right now we haven't seen a big decline on mortgage rates related to the Fed funds cuts.
Yeah, Rafe, I mean, I'm just looking at the 30-year fixed here. It's at 6.39 according to Mortgage News Daily. If it just stayed around that level, Rafe, what would that mean for the sector?
I think sort of continued sluggish demand. I mean, there's two things that think about the housing market. You have the resale market and the new home market. What we've seen on the resale side and mortgage rates at this level, the vast majority of homeowners are still locked in at attractive fixed rate mortgages. So that's keeping the resale prices really high and is pressuring affordability. So what we'd expect is on the resale sides for that to sort of remain locked in and frozen. On the new home side, builders have already pulled back on the pace of starts. So that should help their margins a little bit and start cleaning out some of the inventory that is left over from spring. And then we'd expect them to continue to sort of push on incentives to drive the market. But it would sort of be a stagnant, sluggish market, but not getting any worse.
All right, let's talk about some picks, Rafe, where you see opportunities, some names you like. Toll Brothers, you tell your clients that one is a buy. How come, Rafe?
Sure. So within the builders, we prefer the build-to-order builders over the spec builders in this sort of challenging backdrop. Specifically to Toll Brothers, which would be our favorite home builder right now. We like a few things about them. First, the valuation is relatively attractive compared to other builders, and they do have a higher return on equity. But what we really like about them is the regional exposure that they have relative to other builders. If you think about the housing market right now, the Southeast is where it's the softest. That's where there's a lot of spec inventory. Toll Brothers is more concentrated on the Northeast, on the coast. Also, their core buyer is a wealthier buyer. It's a luxury home builder. The high end of the market has stayed a lot stronger. It's less rate sensitive. They're also using wealth to buy, so they have a more resilient buyer and more attractive valuation.
Rafe, how about Pulte and NVR? Are those also buys?
Yes, both of them are also predominantly built-to-order builders. NVR, again, their regional exposure, mostly mid-Atlantic, Midwest, a little bit in the Southeast, but again, the regional skew there is a lot more attractive. We just expect them to be a lot more resilient in this type of market, just given the built-to-order where they're not starting homes until they already sell it.
And finally, Rafe, Lennar and D.R. Horton, why are those neutrals?
Sure. So we're a little bit more cautious on the spec side of the market, just given the level of incentives that it takes to sell homes right now. Also, especially with Lennar, you're more concentrated in the Southeast where the inventory is more elevated.
Rafe, appreciate your time, those picks. Thank you.
Great. Thanks for having me.
All right, now time for some of today's trending tickers. Yahoo Finance's Alec Canal. Join me here. Take a look at Intel, Tesla, talk a little Starbucks. Let's start with Intel. Seaport Research upgrading that stock to neutral. It's coming amid reports that Intel is in talks with Apple to invest in the company. So this one, Ali, Seaport does go to neutral. Basically saying they're cautious on the long-term fundamentals, but they say in the near term, the stock is likely to be driven, they say, by follow-on investments and the potential for a stopgap solution for the fabs. What do you think?
Right. So the near-term catalyst is the focus on for this upgrade. And, Intel, it's been in the news a lot recently. We have the NVIDIA partnership, NVIDIA committing $5 billion, the White House taking a 10% stake in the company. And then you mentioned, Josh, that report that maybe Apple could invest and there could be a closer collaboration there. Now, this is a potential revival of a partnership that Apple moved away from in 2020 when it launched its own chips. So that in combination is lifting shares of Intel today, this afternoon. But for Intel, I just think there's a long road ahead, and that upgrade did acknowledge that over the long term, it's going to be difficult for this company to really catch up to where the others are in this AI race. It's just been behind the 8 ball for so long. However, you do have that support now from the government that really wants to bring as much onshoring as they can to really boost this AI boom.
Yeah, if you saw more direct investments in Intel, I don't know how much that would really be about Intel, or is it about also a great way to stay on Trump's good side? You like
Maybe.
Intel, we like Intel.
And we've seen all these
billion
tech,
could be worth it.
all these tech executives have been seen at the White House in recent weeks and months. So.
All right, let's turn to now Tesla, the EV maker, seeing European sales sliding in August. Our own Prosper Moranian has this story for us, pointing out Tesla here, Europe sales drop over 20% in August compared to a year ago, marking the 8th straight month of declining Tesla sales in Europe.
Yeah, that means Tesla's market share is just 1.2% in Europe. That's down from 2% 1 year ago. And if you compare that to Chinese competitor BYD, they posted a nearly 200% surge in August. So the competition is essentially non-existent. And actually that might be a 200% surge year to date here. But regardless, Tesla has really struggled in Europe, especially amid these Chinese competitors. Shares are I will say, are up around 20% over the past month. This comes after Elon Musk pledged to buy $1 billion worth of stock back. Year to date, though, we are still only up around 5%, and it's certainly been a big laggard compared to those other Mag 7 names. And, in the U.S., Tesla did have that first mover advantage. It does well in the U.S. There have been more competitors here, you could say, with some of the big three introducing their own EV models. But Tesla needs to make sure that they can get the car profits right. Because even though over the long term, the bulls are sort of hanging their hats on robo-taxis, the promise of autonomous driving, in the interim, they need to sell cars. And that has to happen both in the US, but also especially in Europe. And that just seems to be harder and harder reality for this company to achieve.
Now, Musk did warn, I remember after Q2 earnings, that Tesla was in for said a few rough quarters. And Praz does remind us Tesla will actually give investors the official update of its overall third quarter numbers. That's coming next week. All right, finally, Starbucks announced their plans to close unprofitable locations and cut corporate jobs. So this one, CEO Brian Niccol making moves, Ali, plans to eliminate 900, these would be non-retail roles, close open positions. This is all part of this $1 billion restructuring effort. We will continue to carefully manage costs and stay focused on the key areas that drive long-term growth, he writes. And this does come after the company already laid off about 1,100 employees.
Yeah, CEO Brian Niccol making moves. He was a former CEO of Chipotle. Now he's at Starbucks, and he was specifically brought in to revamp the future of this company that's really just struggled. I mean, underperforming, especially with those stores, posting its sixth straight quarter of falling U.S. same-store sales. So Brian Niccol hoping to reverse that. It's a $1 billion restructuring plan. You mentioned 900 corporate jobs will be eliminated. They're going to reduce the North American footprint by about 1%. And those stores that I mentioned that are underperforming, they'll be shut down as well. And this does bring up a good point to me, because even walking around New York City, you see so many Starbucks every single block. And maybe there is a need to focus on more quality over quantity, and that seems to be the playbook of Brian Niccol at this moment in time. They are going to be reinvesting in 1,000 remodels and rolling out a new lower-cost prototype store with more seating and drive-through options by 2026. So optionality for the consumer as well.
Yeah, September 9th marking 1 year for Niccol now at the helm of the company. And he's got his work cut out for him. In his latest quarterly results, Starbucks did post its sixth straight quarterly drop in U.S. same-store sales. That stock is down about 10%.
It's been brutal journey for Starbucks.
All right, thank you, Ali. Appreciate it. Coming up, will the year end strong when it comes to derivative markets? We're talking to an options expert for everything you need to know about risk, that story, and a whole lot more coming up. Stick with us. While markets have seen a recent pullback from records, the optimism for year-end rallies hanging on as the 7,000 level for the S&P 500 still in reach. But how are derivatives markets digesting the remainder of 2025? Simpler Trading VP of Options Danielle Shea joins us now for a closer look at the options playbook sponsored by Tasty Trade. Danielle, it's good to see you. We know late September, Danielle, historically tends to be a kind of weak period for the stock market, but I am interested what you're seeing in the options markets. How do you want to be positioned here, Danielle?
Well, what we're seeing in the options market is that every single time the market pulls back even slightly, we have buyers coming in. We have retail traders coming in, we have call buyers coming in, and that's why we haven't seen a bigger downwards move. So as of this time, even though we're getting a little bit of weakness over the course of the past couple days, the put-call ratio is spiking right back down as call buyers come in.
Is it too late to hedge, Danielle? I mean, when you look at the VIX, it's been kind of trending up here.
I don't think that it's too late to hedge. I mean, there's still downside possibility here. If you look at the NASDAQ and the QQQs on the daily chart, we've just had a slight pullback into the 21 EMA. So, typically you can get a deeper pullback into the 34 EMA or the 50 SMA. So, if you wanted to add a hedge on here at those levels, that would be down to about 575 in the QQQ. I think that you can. I just think that overall, if you would have been hedged over the course of the last several months, it wouldn't have worked out very many times, right? So you have to take that into account.
Let's say, Daniel, we do see a year-end rally here. You say if we saw it, stick with the Mag 7 names and specifically Tesla, why and what would be the trade there?
So when you're looking at the Mag 7, you just definitely want to focus on relative strength. And specifically with Tesla, we finally had a big breakout move. We have a pattern on the weekly chart that has finally broken out, right? And so for that reason, we're just sitting right below those previous all-time highs. So I'm continuing to trade that momentum to the upside. Obviously today it's down a little bit, but now that that momentum is here, I'm targeting the return to the previous high and then the $500 strike, which I think is possible if we can continue on with this upward momentum.
What about another here named Roblox? I see that in my notes. What's the trade there, Danielle?
So when you're looking at Roblox, this is a great relative strength name with a bullish trend. You could sell put credit spreads in this name because it has pulled back into support, and you could also buy long calls on it, buy the stock, or buy some bullish butterflies. So if you look at this name, we have about a $30 expected move into the end of the year. So that would bring us up into a new all-time high. You could retest that previous level. That would be what I call the easy target. And then after that, onwards and upwards into blue sky territory.
Any other trades, Danielle, that would be on your radar before I let you go?
Right now, I'm looking at Microsoft and Meta as well. These stocks typically start doing well 2 to 3 weeks before earnings starts. So we're right around that time frame. And I think that as we get into the beginning of October, as earnings becomes more in the news cycle, people are going to look at buying these stocks down at the 50 simple on the daily chart. And I think we're going to see them rallying going into earnings.
All right, Danielle, thank you for your time today. Appreciate it.
Thank you.
We're wrapping up today's Market Domination. Don't go anywhere. We've got you covered with all the action following the closing bell. Stay tuned for Market Domination Overtime.